Welcome, everybody, to another episode of Smart Money Circle. I'm your host, Adam Sarhan. With me today is a very special guest, Todd Millay, Managing Director at Choate Investment Advisors with approximately $5 billion in assets under management. Todd, welcome to the show, and thank you very much for being here.
Oh, thanks, Adam. I'm happy to be here.
So, Todd, can you tell us your story and how you got involved in the business?
Sure. I grew up actually in a very small town in Northeast Oregon, far away from any centers of wealth. And my parents were academics who really emphasized education. So I was fortunate to get the chance to go to Dartmouth College and then go on to Oxford on a Rhodes Scholarship where I studied economics. And then I thought at that point I was going to go into economic policy. So I went to law school at Yale. And this was a time when Bill Clinton was president. He was a Rhodes Scholar, so we were all pretty inspired by public service. And the more I sort of learned during my law school time, the more I realized how important it was to get some private sector experience. And so after clerking for a judge for a year on the First Circuit in Boston, I went to work at McKinsey and Company. And that was a great experience. That was essentially my business school. It was very practical business education. And all my clients during that time turned out to be financial institutions. And a big theme of my work was developing products and services for the wealthy. So I spent a lot of time seeing the inside of the investment offerings and other services that big banks and other investment firms were creating for the wealthy clients. And I had the chance to leave McKinsey to join a consortium of family offices. That was my exposure to the family office world. We worked with family offices who typically had hundreds of millions or billions of dollars, providing them with advice and information. And during that time, I was the co-founder of a research center at Wharton called the Wharton Global Family Alliance. It was a joint effort between the CCC Alliance, where I was working, and the Wharton School. And that was an even more interesting window into the sort of global perspective on wealth and how family offices worked. And then I had the opportunity to join Choate, and I've been at Choate Investment Advisors since early 2008. So I joined Choate just before the last financial crisis, and have seen us through a cycle and into the next one. So it's been very interesting.
Very nice. And I know you had mentioned that Choate has been around for 100 years. Can you tell us a little about Choate and what you guys do?
Yeah, Choate, as you said, is a law firm that's been in Boston for over 100 years. And throughout that time, one of its main practices has been to work with successful families as trustee for their wealth. The old story is that the Boston sea captains would go away for months at a time, sometimes years, and they need to leave a trustee in charge of all their business affairs. And in Boston, they chose their lawyers to do that. So Choate has been stewarding wealth and acting as trustee for a very long time. And in the mid-90s, Choate created an RIA to provide the investment side of the advice and staffed it with investment professionals. And that is Choate Investment Advisors. I joined there as managing director, as I said, in 2008. And we've grown to about $5 billion in assets under management.
Oh, wow. Congratulations. And you primarily serve family offices. Is that different, Todd, than managing money for other entities, so to speak, whether they be pensions or individuals or what have you?
Yeah, I think there's a big difference between managing money for families and individuals and managing money for institutions that don't have to worry about capital gains taxes. So that tax awareness is one sort of fundamental divide, I think, in the investment world. And almost all of our clients are individuals and families. And the other is that we take a holistic approach. I think successful investing isn't just about the investment advice. There's big questions about asset location as well. Should you have something in a trust? Should you create a private foundation, et cetera? And that's where having the legal side of Choate and the tax and legal expertise and other services that we're able to provide really provides that holistic family office to our clients.
No, that makes perfect sense. So can you speak a little about or tell us about your investment strategy?
Yeah, so it all starts with the fact that we typically are the stewards of most of our clients' liquid wealth. And so we have to devise a robust portfolio for them at the appropriate level of risk. So the first big decision that we have to get right is that risk question. How much risk is it appropriate for our clients to take? And that really depends on their circumstances. And that's where I think having the holistic perspective is really important. For example, we may have a client who's very successful but has the vast majority of their wealth tied up in a private business, which is risky. And for that client, it may be important to have a more conservative portfolio, whereas I may have another client where it's much more appropriate to have a very aggressive portfolio, say, in the trusts for their as yet unborn children. So we really focus on that risk question. I think that's fundamental. And we design a well-diversified portfolio at that level of risk. And then the other, I guess, key point about us is we're totally independent. We don't have any proprietary products. We don't take hidden commissions. Our only fee is the advice fee that our clients pay us. And so it's really incumbent on us for each of the asset classes in the portfolio to find the best possible way to invest. So we're not embarrassed. If an index fund makes sense, we'll own it for our clients. In other asset classes, we'll go a different direction. And so you see in our portfolio a wide variety of different types of strategies and approaches based on how efficient we think the underlying markets are.
No, that makes perfect sense. So from the holistic perspective, do you tend to be more fundamental based or more technical based or a combination of both? Or how do you approach it from that respect?
I guess I would call us more fundamental. We really believe that the most important decision that an investor makes is that overall risk decision. And then because our clients are very long-term oriented and because our clients also pay taxes, we have to have a long shelf life to our investment decisions. So we can't be churning a portfolio. We can't be making overly tactical trades. We do make tactical positioning moves in the portfolio, but we try to make sure that those have a long duration to them. And so that implies, really understanding where we think markets are going, as well as just a strong kind of grounding in the fundamentals.
That makes perfect sense. So I guess I know you guys are very big on risk, so it kind of leads me to my next question. How do you handle risk, and what mistakes do people see with respect to risk management?
Well, fundamentally, risk is about your long-term strategic allocation. So one way I approach risk is to say, let's do a thought experiment. If I could only invest money for a client once, and then I had to live with that decision for a long time, say a decade, and I couldn't change the portfolio, what would the portfolio look like? And I think that's a really clarifying question because, it takes away a lot of your sort of short-term, fears or optimism and really concentrates your mind on enduring long-term trends.
Right.
So the portfolio that we start with a client is that 10-year portfolio. And then we layer on top of that shorter-term tactical decisions, which we express through the managers we select or through overweights or underweights to different asset classes. The biggest mistake I see people making is to invest what I say backwards. They start with the short-term trends, what stock is hot, where do I want to be, and they sort of arrive at a portfolio by accident, by adding up all those short-term decisions. And I think it's much more productive to go the other way and make sure you have a very clear plan that you can follow in a disciplined way, and then implement that plan on the ground tactically, but always make sure you're following the plan.
No, that makes perfect sense. So I guess from an outside perspective, how do you recommend people learn how to build longer term portfolios by incorporating risk, incorporating the fundamentals? What specific criteria do you look for? Do you look at valuations? Do you look at you said multi-asset classes. Do you look at how stocks are performing compared to gold or oil or other asset classes, or do you look at sectors? If you can explain a little bit more from a tangible standpoint, what can people do to learn how to make proper investment decisions over the longer term?
Yeah, I think mastering the basics is true for anything, and it's particularly true for investing. So really understanding the difference between bond investments and stock investments and the role that they play in a portfolio, and making sure that basic ratio is correct in your portfolio. Within stocks, understanding the way that different sectors and geographies behave, and making sure that you have a sensible mix there, that you're well diversified, but you're also fundamentally investing in sectors that you believe have a strong, long-term prospects. And when it comes to your safe assets, I would be very safe. The role of safe assets in a portfolio is to protect, during moments like we saw in March.
Right.
And so, we try to have a real clarity in our minds between the investments that we have in our portfolios for growth and the investments that we have for safety. And we tend to be pretty skeptical about investments that claim to do both. And we've seen time and again, investors be disappointed thinking they found kind of a magic bullet of a safe investment with high returns. We just think that unfortunately is irreconcilable.
So, how do you determine if something's quote unquote safe?
Well, you can, fortunately, there's a lot of historical data that's available. So I think being rigorous and fact-based, understanding how an investment has behaved in different time frames. And I think one thing that's important is to look at how an investment has behaved during times of real stress, because a long-term average can disguise periods of real instability.
Right.
We saw in 2008, we saw again just this past March that when the markets are under a lot of stress, correlations tend to rise significantly, and assets that look safe turn out not to be safe. So, in terms of our safe assets, we tend to stick to very high quality bonds and cash.
Okay. Makes perfect sense. So, what are some timeless lessons, Todd, you've learned along the way that you'd like to share with the audience?
Well, I guess I'd quote Aristotle saying, we are what we repeatedly do, and excellence is not an act; it's a habit. I think just there's no substitute for a strong method and discipline to follow it. If you have an okay plan and you follow it with great discipline, you're going to do much better than somebody who has the perfect plan but is inconsistent in following it. So we really come back to this notion that having clarity about your overall strategy, and not just including investment strategy, but your strategy with regard to tax optimization, with regard to long-term estate planning, all those things really matter to maximize wealth over time. And just being very disciplined and methodical about following those plans. It's really important, I think, especially at times like this past March and April when markets are so volatile. That again, the people that really get hurt are those that don't have clarity in terms of how much risk they're taking and aren't disciplined about following the plan.
Right. No, that makes perfect sense. So, how do emotions come into play, and how do you make sure that they don't interfere with the decision-making process?
Well, I think investing is inherently emotional, and we know that there are a number of behavioral mistakes that all investors, even professional investors, routinely make. Overestimating their abilities, being more confident than they should be, looking for information that confirms what you already believe. There's a number of these well-known behavioral traps that you can fall into. One way around that, and it's a bit of a self-serving comment, is to have an objective advisor, to work with somebody who's more dispassionate, who doesn't have the same emotional investment in the money that you do. And that's part of the service that we provide to our clients is, we try to be very analytical, very methodical, very dispassionate. And, I think just having that outside advisor perspective is helpful in that regard.
No, it makes perfect sense. So, what are some mistakes that we haven't already touched on, timeless mistakes that you see people make, and how do you avoid them?
Well, one mistake we haven't talked about, in addition to sort of the bottom-up mistake of being overly tactical, of trying to catch on to what's hot and sort of building a portfolio that way, is actually ignoring sort of macroeconomic factors. I'll never forget. I was talking to an investment manager who specialized in emerging market stocks, and he was a classic kind of real bottom-up stock picker, and he's very good at it. But he had owned a company in the Ukraine, and this was right around the time the tensions were really escalating between the Ukraine and Russia.
Right.
And he talked about this company. He said, "Well, don't worry, none of the factories of this company are in the war zone." and thought, well, that's a really kind
Right.
of narrow perspective on
Seriously.
risk. There's
Seriously.
I don't think that the broader market is going to differentiate quite that finely. And you may find if you own a Ukrainian company when it's there's a war escalating with Russia, regardless of the fundamentals, bottom up fundamentals of that company, or the fact that its factories aren't being shelled, stock's probably going to go down, and
Right.
that's in fact what happened. So, I think really understanding the macro picture. Time and again we've seen these big events come along, whether it was 2008, whether it was a COVID crisis, or smaller things like the fears about China that we saw back in 2016. And those have profound effects on portfolios, and you really need to be sure that you're cognizant of that in putting an investment plan together.
No, it makes sense. The fears about China in 16 or in 18?
Well, really both. I mean, the first, as I recall, the Chinese equities sold off fairly hard in the summer of 2016, because there were, fears at that time about the level of indebtedness and so forth. There was
Right,
sort of
right.
that mini scare then.
Cool. So, Todd, I have a question from a normal person standpoint listening to the show. I'm not an investment advisor, an individual investor, but I want to accumulate wealth over the long term, and I want to avoid the pitfall of just staring at the market, or what I call tickositis. When you stare at the screen every tick. But how do you, remove the not so much the emotions, but how do I step back and allocate from a 10-year standpoint? It's a very broad question. It's a great question to ask. What stocks do I want to own over the next 10 years? And then how do I go, or just assets in general? How do I go about answering that question?
Yeah, I think one overall question that I'd ask myself is, how do I ever avoid making a temporary loss permanent? How do I put myself in a position where I'm not a forced seller? And the first way to do that is to make sure that you are taking the right amount of risk. It gets back to that 10-year portfolio question that we were talking about. You never want to be at a point where, gee, if I was down 10%, 20%, 30%, that's when I'd have to sell.
Hmm.
And so you want to really understand your own situation and make sure that it's very unlikely that you're ever going to be put in that position of being a forced seller. Because few things are a bigger mistake than making a temporary loss into a permanent one. So that'd be my first piece of advice, is to think hard about that question. And then the second is, just really there's no substitute for thoughtful diversification. You don't want to be over diversified in a portfolio, but it's really important to protect yourself against unforeseen risks. I mean, the virus is a classic example of that. You could have owned a great portfolio of travel stocks and restaurant stocks, and thought you were reasonably well diversified, and just had that rug pulled out from under you by a totally unforeseen pandemic, which hasn't happened for 100 years.
Right.
So we do think that being well diversified just is essential for any long-term investor.
No, that makes perfect sense. So the first point about the temporary loss or permanent one, uh, just to help me understand it, is that you buy a stock and it goes down 4, 5, 6%, 7 or 8, 9%. Typically, you'd have a stop in there if you're a trader, and you'd get out at a 7% loss or 10% loss. As an investor, you might give it some more room, 10 or 20% or 15% or even 30. But eventually, you're going to just blow out and say, you know what, this is a wrong idea. So do you guys use stops, or do you just say, hey, don't use stops and just watch the fundamentals and watch the story, and then if that changes, that's when you sell? Or if you can speak to when do you sell a little bit, that'd be very helpful.
Sure. Yeah, I think for the beginning investor, I would go the route of mutual funds and ETFs rather than trying to pick individual stocks, because there's so much more risk in an individual stock than there is in a diversified fund or for an ETF typically.
Right.
And I think you are more susceptible to that, sort of getting just pushed out of a position, because individual stocks typically are far more volatile. In terms of when we decide to sell, we really are questioning our thesis around the investment. We're looking at its valuation, and we're wondering if something has just fundamentally changed that we didn't foresee when we made the investment. But we try to be selling when we think something's expensive, and has gone up rather than when it's gone down. But one example of us selling was commodities. Commodities are a great diversifier in a portfolio. We have owned them in the past for clients, and we became more and more convinced in the wake of the financial crisis that we just didn't see the forces that were going to create inflation, and that diversifying power of commodities was really premised on the idea that they held their value in an inflationary period. And so after a lot of work, a lot of thought, we exited fully from commodities in our portfolios. And obviously, as the years have gone by, that's been a good decision. It wasn't easy because there was a lot of merit to investing in commodities, and they do provide great diversification benefits. But we fundamentally thought that post-2008, the risk to the global economy was more deflationary than inflationary, and that's what led to that decision.
Interesting. So, from a permanent loss turning into a temporary loss turning into a permanent loss, how do you know when the story changes? Do you look at the price, or do you just look at the company and say, hey, the earnings are no longer going the way we want them? Or if the stock goes down, you just leave it to go down as much as you want, buy more of it, and then when it goes up and it becomes overvalued, that's when you sell it. Just so I'm trying to understand the sell side of it.
Yeah, again, with individual companies, I think it's challenging because you can have a great company that just gets fundamentally disrupted.
Right.
BlackBerry was a great product,
Right.
but it just fundamentally got disrupted. So there may be individual companies that are sort of irreparably harmed by innovation, and you don't want to ride those all the way down. I think, what we look for when it comes to individual companies is, do they have a differentiated product? Do they have that sort of, Warren Buffett moat around the business? And in this environment, do they have financial strength? Are they going to be able to get through to the other side of this pandemic and quarantine that we're in at the moment? Because companies like that, should actually do better on the other side of this and face actually less competition. And then finally, we look for companies that we feel are benefiting from a long-term secular trend. In some ways, the virus is accelerating trends that we already saw in the market, like, the move to digitization, the move to online shopping.
Right.
And so if you have companies that are benefiting from those trends, then I think you can feel confident that even if they're temporarily down, you don't want to sell them.
No, that makes perfect sense. So I guess my other question would be valuation. Value, like beauty, is very subjective. It's in the eye of the beholder. What are some metrics, or how do you determine value?
We don't rely on any one measure of value. There's a number of ratios: price to book, price to sales, price to earnings, et cetera. We also really look at a company's long-term growth prospects in terms of valuation. Again, it gets back to our idea that if we're in a sort of fundamentally deflationary, low-growth environment, which we still believe, then a company that can grow is valuable. A company that can consistently grow its profitability is quite valuable to own. And it's worth paying more of a premium for a company like that because it can grow its way into a solid valuation than a company that has low growth prospects. So, right now there's a huge disconnect between growth and value companies. And we don't think that's necessarily as irrational as it appears to be on the surface.
That makes perfect sense. So you look more towards the growth going forward, and then you extrapolate value based on what you expect the growth to be.
Yes, and obviously there's a lot of conjecture involved in that, so you have to be careful. But that's where diversification comes in.
So we've covered a lot of ground here. I guess the other side would be just if you can elaborate more on diversification. How do you build a well-diversified portfolio? Do you look at valuations? Do you look at future trends? So on and so forth.
Yeah, I mean, partly it's understanding clearly where you think the world is going, and making sure that you're not placing too much of a bet on any one particular outcome. The other is just understanding history. Again, the market provides a wealth of data in terms of how investments have behaved in the past, and in a lot of ways, that's our best guide to the future. So we spend a lot of time analyzing that and trying to understand, how different investments have behaved in different circumstances, particularly in extremes, because the value of diversification really comes into play at those moments. And we want to be sure that any investment we have, which we feel is providing us diversification, actually does it when it really matters.
No, that makes perfect sense. Are there any good resources that you would recommend the audience go to find out how those past performances or the asset classes had performed in the past? Or is it just, hey, look at the charts and do some research based on economic data and so on and so forth?
Yeah, there's an awful lot available now in terms of data. In some ways, the problem is there's too much data and not enough insight or analysis rather
Hence
than
my
the
question.
opposite.
Right, right. That's why I'm
But I would,
asking.
sorry?
That's why I'm asking. Hence my question. If you had any good
Yeah,
sources.
I would try to find resources and sources of information that you think are consistently high quality. For me, The Economist magazine I find is consistently pretty insightful. Consistently does a good job summarizing not just economic trends but the broader political context. So I read that pretty religiously. I think the Financial Times is a very good newspaper and has a good sort of global perspective on things. So I would recommend that as a resource. And then I think you can't go wrong just reading some of the classic books on investing. Things actually change less than you would think. So even getting back to your Graham and Dodd, isn't a bad thing to do as an investor to learn more about the markets.
No, that makes perfect sense. So I guess, Todd, my final question here is matter. What's the best piece of advice you'd like to share with the audience on a rough Wall Street?
Well, I think understanding history is really important. And I was fortunate, in my education to get a really strong grounding in history. And when I was at Oxford, when I studied economics, it was part of a degree called Politics, Philosophy, and Economics. And those three things actually go together. I don't think you can divorce the economic environment from the political environment and from the environment of ideas.
Right.
And so the more you understand kind of how these things have evolved, the better. And I'm having my team read books about the 1930s right now. We really need to understand long-term history because I do believe that there are long-term cycles and patterns, and it's important to be able to recognize them.
So on that note, I know I said final question, but you just keep bringing up more, triggering more things in my mind. What are some of your favorite books that you recommend people read on investing and history?
Well, David Swenson's books I think are very good. The guy who manages the Yale Endowment.
Yep.
The Lords of Finance I think is one of the great classics, and that book in particular kind of highlights the power of ideas in investing, and you can read about all the terrible sacrifices that England made just to hold on to the gold standard for far too long, for example, and it sort of makes you wonder what misleading ideas are motivating policy at the moment. So those would be some that I would start with, in addition to kind of the obvious classics like I mentioned, Graham and Dodd.
Nice. Makes perfect sense. Well, Todd, thank you so much for coming on the show. What's the best way for people to get in touch with you?
Well, thanks a lot, Adam, for having me. I enjoyed the conversation. People can call me directly. My number is 617-248-4770. My email address is tmillay, TMILLAY, at choateia.com, CHOATEIA.com. And that is our web URL if folks are interested in learning more about us. We publish a great deal of research on our site, including regular updates during this pandemic, and invite anyone who's interested to start there to learn more about us.
Beautiful. Well, thank you so much, Todd. We'll talk to you again soon.
Thank you.